All right, Nifty definitely closing in the green. It's a strong close for the markets today, and it's a fabulous Friday for the markets. And so far this week, also Nifty has managed to end with about 0.5% gains. We'll wash out whether or not this gain sustain into the next week, given that we have some new reports where they have indicated that the military action between US and Iran could escalate. And we'll watch out whether or not this takes place as well. But yes, to talk about the markets and broadly where we are headed, let's quickly get on board with the next guest of the show. We have market expert Sunil Subramanian joining us. Good afternoon, Sunil sir. Let me ask you the first question. I mean, the war risk premium has been built in after US President has given about 10 to 15 days deadline to Iran for reaching a nuclear deal. At this time, how are you assessing the market sentiment?
Well, I think that as far as India is concerned, it's just a reaction of day traders, speculators, hedge funds, and algorithmic traders. Because honestly speaking, it doesn't affect India so much. I mean, a short-term spike in the oil price, I don't think is sustainable because I think the World Energy Agency had already indicated about 3.5 to 4 million barrels of oil excess supply by the year end based on the current thing. And India anyway has stopped buying oil from Iran post the sanctions. So this is more expectation of the traders that there would be reaction. And there, yes, yesterday's market correction was that. The reason I also say that is because if you look at the DIFI numbers for yesterday, they were under 1,000 crores of selling. So I'm not sure that that's what caused the 1,700-point crash, right? So it's more like getting the triggered stop losses getting triggered and all those kind of things which has done that. So it's a speculative reaction to the market, and I would say that that continues. And so I retain my stance that for a longer term view based investor, these corrections which are not correlated to economic fundamentals of the country are actually buying opportunities. So I have a very simple thing here because it was absolutely not warranted, the kind of correction. But like I said, a lot of positions built up, nervous panic among retailers and overseas hedge funds. Not to blame only the Indian retailers, but overseas hedge funds also had probably taken positions based on which this happened. So I would say ignore the noise of geopolitics. This particular geopolitics is not critical for our economy. Otherwise, if you see, there's been so much of good news around the economy, which has seen the FIIs reduce their selling dramatically this month. If you take that one day of Thursday out, right, where there was an IT sell-off based on the Anthropic, announcement, and it was a worldwide IT sell-off where India also got hammered. If you take that one day off, which was 7,500 crores of sales, the rest of the week, in fact, just out of the budget, there was a lot of short covering, and that day was 5,500 positive. So overall, I would say there is a change in the long-term FII's view of India. With all this good news, they've reduced their selling. They'll wait for some more reinforcement in terms of future earnings seasons and the government following through on a lot of the budget announcements before they commit larger capital. And the only thing is that, which was a bit surprising and perhaps, but now we can understand is DIS also haven't bought much this month. It's only about 11,000 crores, I remember, till yesterday. Whereas January, they bought almost 70,000 crores. And there's no way they're going to get to that number in another 10 days left, right? So clearly, DI have reduced their buying, partly because the earnings season they were waiting to complete. So that should step up now. But also because flows to DIIs from the investors have also dropped because investors have shifted their attention to gold and silver. If you see gold ETFs, 24,000 crores, silver ETFs, about 5,000 crores, and then multi-asset funds, another 10,000 crores. So almost 40,000 crores of money has been allocated by investors this month towards gold and silver oriented assets. So clearly, that's probably also make sure that DIs don't have as much money as the previous month to buy. So that's also contributed to the fact that the market has not yet respected the Indo-European trade deal, the Indo-US trade deal, a pro-economy budget, and all of that.
Got it, got it. But Sunil sir, what about, the Brent crude price is rising. I mean, does that play a spoil sport in our inflation math? Because, of course, it's just a temporary reaction like you were talking about. But some reports, they've been indicating that the Brent crude prices can rise by about $10 to $12 per barrel, given the kind of underperformance they've seen in the past couple of months. So, I mean, do you think that this is something that one should be concerned?
I don't think so. Because one is that the spike in oil is a sentimental spike. Like I said, Iranian oil is anyway not available in the world. So a war with it causing any reduction. The Hormuz Strait, which they control, preventing flow-throughs of oil is the concern. But given the relative things, it's not like a Russia-Ukraine war, right? America would go in there in probably max of a week, that war will be dusted and settled. So it's a short-term spike. So unless it's a sustainable spike, one. Two is in the basket of CPI inflation, it's what about 10 to 11% is the max impact of crude. So I'm not sure that it's going to make that big a difference to it. Third is that Indian economy, as last year and all in the year before, easily absorbed a $75 crude price into the economy without any deleterious effects. So I would say that getting to 75 or something is not. And like I just mentioned in my previous response, overall energy demand supply situation says that there's 3.5 to 4 million barrels of excess supply projected by the year end. So to that extent, I would say that oil is not that big a concern. But for a stock market participant, like say an algorithmic trader, who among various variables that he puts in an oil price as a negative for India and then decides to buy or sell based on that. That's entirely computer algorithm driven, and there could be selling because oil breaches a certain. But like I said, that's a short-term negative reaction, which is not justified by either the economic impact on India or by the actual inflationary impact. One is, I don't think it's going to matter to our trade deficit or fiscal deficit unless you're seeing maybe 3-4 months of continuous sustained oil above $80. I'm not sure that it's really a big concern.
Okay, got it. But at this point of time, when we're seeing OMCs coming under significant pressure because of the sentimental decline, would you advise investors to go about and buy the dip? Fundamentally, how do they stand at this point of time?
My view on the commodity part on this itself is that it's a very high risk, high reward part of your portfolio. Keep to 5 to 10%. And at any times, people talk about commodity super cycle. People talk about this. The biggest challenge for all of these is that it's too much news flow laden. They shouldn't be a core part of your portfolio in any case. So I would not say that those oil refining stocks are all something that you can stay on the sidelines and watch the fun, rather than go and say, because there's not fundamental things, right? See, what happens when oil prices increases, right? Why is the worry? Why are these getting hammered? Versus, of course, refining margins actually should be better because the price linked to the price. But the government may, in order to protect the retail customer from the inflation, make them absorb the burden of increased prices and control. So when there is such amount of regulatory risk around this, right, on whether they will actually get the profits from higher oil due to higher refining margins or not, it's a no-go from a thing. If you're a high-risk speculative trader, want to bet, fine, but not as an investor. It should be a part of your allocation because overall, like I said, it's a high-risk part. Keep it to 5% of your portfolio, and in that context, you can keep it. But I wouldn't say that you should react to these kind of a geopolitical risk and then immediately go and punt on it. I mean, you're a speculator, fine. You take a view, that's okay. You're relying on technicals, you're relying on all of that. That I'm not an expert on that side of part. But on a fundamental basis, I would say there's the high regulatory risk around this sector. So that's always something to keep in mind.
Got it, sir. Sunil sir, I'll pivot the conversation to the hits and misses of the third quarter. Everyone has been saying that double-digit growth is possible. And of course, there's a broad-based recovery which we have seen across the sectors. I mean, for you, how does it look like for the upcoming quarters in the Q4? And of course, what are your estimates for FY27?
So, and I did analysis, I did it for the top 3,000 companies, and I did it by the AMFI classification. So not necessarily by the index. So if you take the top 100 companies, I saw that the EPS growth was about 7.2%. But then I looked at it and said the labor code impact, because IT is a significant part of the sector, they are high employers, banking are big employers. When I took away the impact of the labor code one-time provision, the actual numbers came to 11.5%. So for large caps to post double-digit growth, I think it's a good sign of recovery. Mid caps, according to my estimate of the 101st to 250th stock, delivered about 16%, and the small caps delivered about 28%. So I think that to me, the earnings season was fairly good because overall labor code impact took away 15,000 crores from stock market profits, which is about 6% of the total profits of the stock market. So I think that was the reason the numbers, perhaps some people viewed it badly. I think of it as a beginning of a U-shaped curve. So hence, I've upped my guidance for next year, my expectations on the Nifty itself to about 14%, and to the mid cap index about 20%, and the small cap about 25 to 28%. So I clearly believe that we are on the cusp of a U-shaped recovery. So mid and small caps should do better than large caps purely based on earnings. Only thing to counter that is that valuations of mid and small caps are still significantly at a premium to the large caps. So that will temper down. So I would still go for a diversified portfolio across large, mid, and small, and still keep large caps at 40% of your portfolio, and 60% you spread between mid and small caps is the way I would look at it. So I believe that, and these numbers that I spoke about in earnings are for FY27, not just the next quarter, because it's going to be a progressive implementation of the GST cuts, through the year, start of the implementation of the trade deals and the budgetary impact. So it'll pick up, it'll gather pace as the quarters go by. The immediate quarter, I would like to see the consumer durable space, especially the cooling related durables, because auto had a blowout quarter, 30% plus EPS growth. So I expect the similar numbers to come from the consumer durable space for the first quarter of the new financial year.
Okay, consumer durable stocks, that's what you're bullish on. Sunil, I was reading your analysis on LinkedIn, quite interesting, and you mentioned that you expect a gradual recovery in the IT services sector. So amidst all of this AI scare and jobs undergoing a change, I mean, the question has always been whether there's going to be a sustainable revenue model for the Indian IT sector, which has been, focused towards the service-oriented fixed models. I mean, going ahead, what's your thoughts there?
So first of all, I think Indian IT has been a bit unlucky, and I'll tell you why. I think that even before the Anthropic thing broke out, right, over the last year and a half, Indian IT has been punished for being perceived to be non-AI ready. Okay, now it's partly true, partly not true. That's okay, leave it. But they got punished already, right? And when the Anthropic broke out, the worldwide IT services got hammered, not India alone, and India got hammered with that. So this kind of a bloodbath, effectively double time you got punishment for the same thing, right? I think that has led to what? I was looking at the 1 year returns. 1 year Nifty is given roughly 12%, I think, and IT index is down 20%. So you're talking about a 32% underperformance to the Nifty, right? Now that's, I believe, a major overreaction, number one. Number two, the labor code impact. Okay, I will come to AI in a bit. Labor code impact, if you take off the labor code impact, right, from the IT companies, their revenue growth was positive compared to a minus 5%, which they reported in the quarter. So for next year, because you'll have a normalized year with about 10 to 15 basis points margin cut by the continuing labor code implementation, the one-time poison has been absorbed. There's still a projection of 11% rupee, because part of it comes from rupee depreciation, part from constant currency growth. I would say about 11% earnings growth for the current year. So I would say that the bad news is not in terms of the immediate earnings. The bad news, as you correctly pointed out, is in terms of their business model. Now, to sit and think that the model is going to affect every IT company across the globe. So whatever they are all competing, they are competing. Now, where is the impact? The AI impact is on three separate spaces, right? So first is that AI will be a benefit to IT companies to internally re-engineer their back-end operations, not the customer-facing front. So they'll save a huge amount of money by bringing in AI into their own operations as a company, right? How do they deal with stuff? How do they do various functions? So there, I'm sure that they will take that benefit on. Second aspect here is that if you look at it from a customer end perspective, AI is going to affect the whole wide range of industries, right? Consumer, manufacturing, banking, you name it, is going to get, and everybody will be eager to use AI to do what? to bring productivity improvement, to reduce their employee dependence. That is the user end, right? Now, how are they going to do that? How do they have a clue as to how they do that? They have to depend on an AI consultant. And who better to do that than existing IT services companies, whether they are Indian, whether they are outside, right? So clearly, AI consulting is going to be a new business growth path over and above software as a service, over and above SAP multi-year integrations, which are the two businesses getting impacted by AI. So obviously, IT companies have to undergo a change in the business model. But what works in their favor is that one is that they have cash on the balance sheet. They have good balance sheets and they have good cash sitting on it. So I was not very happy with that doing buybacks with the cash. Rather, they should go out and acquire medium-sized AI companies to be at the frontier of AI consulting. They should be actually investing in data, the centers and AI-related stuff, which some of the top companies have started doing. And the third is that they should be they are very good dividend yield with this correction. So there should be a sense of a longer term pension fund and everything who looks for good. Their dividend yield, because of this correction, has doubled from 1.5% levels to 3.25. So they will get some degree of buying support over the year from a longer term income seeking institutional money, right? Now, finally, the biggest advantage these people have is the relationships they have with the Fortune 500 companies across the globe. Why do I point this out? Yeah, their existing model will change. There will be volatility. There will be some quarters from the following year onwards where they will have to do. But the relationship will mean that they get the first right of refusal for any AI consulting job. As long as they spend the next year doing the right things there, tying up. You've seen already, somebody's tied up with Anthropic, somebody's tied up with. So they have to do all of that rejigging. And in that process, there will be pain of employees being let go. There'll be new AI-oriented jobs for which the college graduates can equip themselves. But the existing force, there will be some amount of attrition and retention. You can't help that. So in that process, and not every IT company will be the winner, right? So end of the day, there some people change fast, some will change slow, some will be aggressive. So it's going to be that there will be definitely some winners. So why to sum it up, I believe that for all of the reasons I said now, that IT, I believe it should be a gradual buy on dips from a medium-term perspective. In the immediate future, their earnings growth is not going to suffer, so their valuations will look quite reasonable. But the longer-term business model change will lead to some pain. But see through the pain, stick with the companies, and I would prefer the larger companies to the smaller companies here, and build a portfolio which should be also 10-15% of your total overall portfolio should be in IT. But buy on dips, keep staggering, keep buying, have faith in these IT companies that they will change in a big way. I try to draw a parallel between a tiger and an elephant. They're more like an elephant. They'll move, but they'll move big significantly. So a year from now, we could be having an entirely different conversation on IT, on how these companies are at the forefront of the AI disruption that's happening in the user industries. So I think, sorry for a very long answer, but I just wanted to take a look at this. And something like a 32% underperformance to the large cap index, right? I don't think it's sustainable. They'll definitely narrow that gap, which means that there's money to be made.
That's right. That's right. I mean, time will be a virtue of it, given that, from having cash buffers to implementing and going into the AI-led execution mode is something that everyone is going to be watching out. But Sunil sir, what about, let's talk about PSU banks. Nifty PSU bank has once again hit an all-time high today. And in the past 6 months, we've seen it's a roaring rally for all the PSU banking counters. Do you think the re-rating story is still intact, or how do the valuations look like at the current juncture?
I think it's moved from, it was the initial rise was a re-rating story. I think now it's based on the fact that when you look at, apart from retail consumer lending, right, in every other space of the lending space, whether it's in gold loans, whether it's in agri loans, whether it's in financing the MSMEs and the SMEs, or it's in financing large corporates with a 5,000, 10,000 crore size loans, right? PSU banks clearly have an advantage in all of these spaces. It's only in the EMI-driven retail, consumer durable, auto play that they because of the slower turnaround and all of that, they have not been. The private NBFCs and the private sector banks have a clear lead there. So they are essentially wholesale lending banks. So I think that with the economy now going through this phase with all the trade deals getting implemented and the budget giving the economy a boost, this lending across the spectrum from MSME to SME to all the companies, it's these people to be on the at the forefront of it. So their loan books should grow very well. Plus, the whole moratorium post-COVID and everything has enabled them to bring their NPAs to a fairly decent level. So that's the second thing in their favor. The third is the news around this new committee that the budget they announced about forming. I believe the ultimate goal of that committee is to lead to a mega PSU bank merger, where we'll be left with 4 or 5 big PSU banks, right? So that they can raise capital at internationally competitive rates from either dollar-based loans or rupee-based masala bonds overseas and raise longer-term financing, because the 5-year, 7-year, 10-year loans or whatever the lending for the capex cycle is all very long-term. It needs that balance sheet strength for you to borrow match to match. I know deposits, there is a challenge, but they have to find alternative sources. And for that, your bank has to be of scale. So I believe the big move, which will be announced during the course of the year, will be a mega, leaving us with just 4 or 5 decently global size. I'm not sure we're going to get into the top 50s, but at least a 50 to 100 kind of a ranking banks, which can raise capital from international markets of a longer tenure, so they can match the corporate lending with that. So I think all of these positives are there. It's not just a re-rating story, though there is still some juice left even in the re-rating story. Price to book levels, there's still gap between private sector banks and the public sector bank. There is still that, but the new drive, I think, is from the fact that the economy's growth, I think, has to be financed by the public sector banks, and that's what I think will drive the next. And for my next year also, I expect them to deliver in excess of 20% EPS growth for FY27.
Got it. So, sir, what about the capital marketplace? Definitely, they were the talk of the street this week itself. We've seen BSE Angel One, they declined by about 5 to 8% this week itself. I mean, how are you seeing this? The RBI tightening of the lending norms, the earnings impact of it, and of course the volumes remaining the key question in the derivatives market. Going ahead, what is your assessment of this scenario?
I think RBI's move is more from a discipline in the lending process and capital markets. It's a welcome move overall from a credit quality perspective. Definitely, it's been a negative for the capital marketplace, but I would say that India's penetration and those levels of growth that we are going to see in this stock market penetration would take care of these. So I view this as a temporary blip in the play, and it's again something that with a medium-term outlook, I would say you keep buying it on dips. Right? Yes, the news was not positive. That's true. And that's why the market is reflecting that. But I don't think fundamentally their business case in a place like India, with your penetration so low and growing so fast, right? All these companies are set to benefit from that overall larger story. So I would say that the market will soon go back to rating the longer term and absorbing this short-term negative because of the RBI decisions.
Okay, got it, Sunil sir. All right, Sunil sir, on that note, we have to let you go, but thank you so much for joining us.
Thank you. Thanks a lot.
All right, that's all we have for this edition of Closing Bell. It's a wrap from me. Thank you for watching and do have a very good weekend.